Hey guys, how you doing? We got people coming in now. Always good to know where people are from. If you want to drop a note in the Q&A, and looking forward to chatting with you guys.
All right, California.
Howdy, man.
Yeah, and for those that don't know, I'm in Ventura, California, so Southern California, just north of Los Angeles, and my office is in Los Angeles. Kevin.
Familiar faces.
Oh yeah, cool.
Good. Cool. We're filling up. I'm going to give people just a minute or two and try and get as many folks on the line as we can. So we're answering all questions and go from there. So appreciate the patience from everybody.
Thousand Oaks, hey. And yeah, anyone that's real local, I'd love to hear what meetups you guys are going to. I pop in and out of a few around here, mainly a little closer to my office in Sherman Oaks and LA, but like to see what else is a little closer to home.
People from all over. That's the one interesting thing about the times we're in now. You get people from all different time zones when you normally couldn't get them. So it's good. I guess we all get to be together for a little while here.
Yeah, and then from a mortgage originating perspective, it's never been something like this where someone like me in Los Angeles can be originating loans in Ohio, Florida, Texas, Tennessee, Pennsylvania, and right in my own backyard, all in the same week. So
Yeah, no, we've got to get into that too. And everywhere you're helping people out, it'll be good for everybody to know for sure. Netherlands.
very cool.
Yeah.
We if there's time, maybe we'll even touch on some foreign national programs too.
Are you investing in the U.S., Thomas, coming from the Netherlands, or what are you doing there? You got a message there, Alex. Dude, I'm in Thousand Oaks. So
Yeah, I know. That's what I was laughing at because
okay, good,
he must have heard Ventura. That's just over the hill there.
awesome. Cool. I'd say we start. We got a good group. We got about 30 folks in here already. Investing in Colombia, excellent. So we could talk about that a little bit, Thomas. But excellent. So we got a good group coming in. As you guys saw on the invite tonight, we really want to get into questions about lending and financing and refinancing your projects. Obviously, in an interesting time for all of us. We're going to focus things on the BRRRR strategy as always, and brought in Alex Bequeza tonight. He's from California, originating loans out from there, and is specifically focused on the BRRRR strategy. I'll let him introduce himself for the folks that don't know me. My name's Adam Jason. I'm the founder of BRRRRinvest.com. Really what we do is help people focus on the financial freedom goal that we all have through the BRRRR strategy. We've built a solution for folks that encompasses deal analysis, making offer letters simple and easy for folks. But the big one is really the contracting solution that we've put together for folks that I built based on 10 years of being a lawyer and 10 years as an investor as well. So I'm primarily focused in real estate and securities and corporate finance, but I've represented some of the biggest companies around the world, Sherwin-Williams and other companies that you would know do deals all over the world and a lot in the real estate space. So what I've done is really said, there's a lot of investors who hire property managers, contractors, lease to their tenants, etc. And how do they do it? They pull the first document they find off Google. They take the contract that their property manager or contractor gives them and they sign it, or they hire an expensive attorney to do the work for them and draft contracts that are favorable to them. or they don't work with a contract at all, and it sets them up for problems. So what we've done is made a simple click-through solution, super investor-friendly provisions that I use for all of my deals and that are based on my experience and that I've included over the years as I've seen issues come up and found legal ways to deal with those. I also now work as head of legal and partner for Life of Far Investments. We're based out of Colombia. We've done about $80 million in deals in the short-term rental and boutique hotel space in Colombia, and now we've expanded into Puerto Rico, Portugal, and beyond. So focused on real estate, love it, love the BRRRR strategy. Been fortunate enough to have some success in that arena, and it's brought me along to meet some interesting folks like Alex. So Alex is the man with all the knowledge tonight, and I want to give him a chance to introduce himself to you guys and go from there. We'll start diving into it. Format will really be, I'll start with some questions, and then I want to open it up to you guys and make sure you have all the opportunities to ask Alex or myself any questions that you might have when it comes to BRRRR or primarily lending. So Alex, take it away.
All right, cool, thanks. So yeah, like you said, I'm a mortgage loan originator in Los Angeles. You know, that can mean a lot of things. Specifically, I focus on niche investor products. I think most people in my industry tend to focus on paper conventional financing for home buyers. But for me, bigger pockets and a couple other resources like that, you know, really, I use them as a learning resource, and it quickly changed my trajectory as a loan officer to, oh, I want to serve these people, you know, investors. What are they looking for? Hard money, commercial financing, private financing. And so I guess you could lump what I do into three basic categories. Fix and flip financing that could be interchangeable with the purchase end of a BRRRR. Commercial, long-term commercial financing that is also viable for 1 to 4 units, residential units, and small balance commercial financing for apartment buildings and commercial buildings that just kind of miss agency debt standards. And yeah, other than that, on the personal side, I'm 29. I have 2 kids, one with special needs. And so, you know, these strange times bring all sorts of chaos to our lives, and the lending world is no different. And so I've been trying to help all my clients and new clients kind of navigate these waters. And I guess we can kick it off for some questions, Adam.
Yeah, sure. No screaming kid in the background, which is unusual for conference calls. And
I'm married to a black belt ninja.
Good. Cool. Well, let's jump into it. I think, you know, we'll take questions from folks, but I'm going to assume that people are familiar with BRRRR and the strategy and are, you know, starting or have done some projects and kind of familiar with acquiring a mortgage and finance, refinance, etc. So I guess it would be interesting to hear from your perspective, Alex, kind of how the status quo has changed in light of coronavirus and the economic issues that we're seeing, unemployment, etc. What are you kind of seeing from what people might have expected going through a finance or refinance, call it 3 months ago?
Sure. Yeah, I'll try to paint some broad strokes here, you know, not to get too lost in the shuffle, and then,
Sure.
You know, it'll take us where it does. So, you know, like sometime in March, you know, everyone started really realizing the gravity of this pandemic, as we saw businesses being forced to shut down, millions of people filing for unemployment, the stock market taking a huge dive. You know, I personally saw my portfolio drop 19%, and I think a lot of people fared a lot worse. And so this has a direct impact on all types of non-government backed financing, which is very, very commonly used in the BRRRR strategy, and all types of real estate investing. And that's because since they're not backed by the government, these loans rely on investors on Wall Street to purchase these loans, right? So the lenders usually have large warehouse lines of credit that they have certain guidelines under which they know that investors on the secondary market have agreed to buy them under, right? Basically, when the stock market took a dive, the appetite for those loans that were not based on the borrower's income, rather they were based on rental income or simply an asset-based type of structure, quickly dried up. You know, it was like before lenders could even understand what was going on, it was like the light switch went off and then slowly each bulb kind of went out, you know, over the course of a few weeks. For anyone who had a loan going at that time, they might have experienced some of this, where you had some lenders quickly shutting off the pipe and saying, you know, we're going to suspend operations until we can assess risk properly in the market. You had others quickly create super conservative guidelines. You had others that said, oh, business as usual, send us your loans. We'll take the fallout from all the other banks. We're still in business. And within 24 hours, they were doing a complete 360 in there and what they were saying. So it was a really rough couple of weeks. I personally had about $6 million worth of small BRRRR loans get paused. I mean, that's $6 million worth of like $150,000 to $250,000 loans for the most part, with a few exceptions. Pretty much all of those are still kind of on pause. And hopefully most of them will get moving again in the next few weeks. You know, luckily, all the ones that I had, no one really had a true gun to their head in terms of like a ballooning note, or those that did were able to work extensions out. But so anyway, to get back on track too, so we saw the secondary market for the commercial side kind of fall out. Then you saw, you know, the CARES Act and a huge wave of forbearances, right? Lenders weren't even allowed to ask why or do any due diligence on whether or not you should be qualified for a forbearance, right? It was just you get to get a forbearance if you go apply for one. So this quickly created a huge lender liquidity issue. The Fed and the biggest mortgage lenders in the world were quickly trying to solve it, right? Just from a cash flow standpoint, you can't have millions and millions and millions of loans just stop paying, right? So yeah, we saw this lender liquidity become a huge issue. And then essentially what followed was Fannie and Freddie's guidelines remain the same, and they still remain the same today. But the conventional lenders who write the loans for them all added huge overlays to be safe. And so you saw this one by one. Certain things started falling off. First, all the non-QM stuff, commercial stuff, non-agency stuff fell off first. Then you saw jumbo loans pretty much disappear. Or if they didn't disappear, they were outrageously expensive. And then you saw the most recent thing that's really hurt investors was big overlays for cash out refinances. So the most recent addendums to this bailout were basically that Fannie and Freddie will continue to buy mortgages even if the borrower goes into forbearance. The exception is loans that go into forbearance that were cash out refinances. So with that added risk of potentially writing a loan and having no way of knowing if that borrower was going to forbear it in the first few months before they got rid of it, what most big lenders did was either suspend cash out refinances or price themselves out of the market. But a lot of the biggest names, like some Super Bowl commercial style big names, took this as an opportunity to capture the market. So they still are offering cash out refinances. I'm in the middle of a couple right now. Something I've done just to fall back on in these times where commercial is obviously paused. And so that's kind of where we're at right now. And so like for someone like me who focuses on commercial financing, where we're at right now is, you know, we just saw a couple of non-QM options begin to show a pulse. And what they've kind of done is roll out super conservative measures at first. Angel Oak is one of the biggest non-QM lenders in the country. If you followed the news at all, they were probably the first headline to come out. You know, Angel Oak suspends operations and lays off 300 salespeople. They've resurfaced with some really strict guidelines that really don't do investors much good. It definitely, you know, bails out some people, but they're only doing purchase loans and rate and term loans. But this is still a great sign. This is a sign that things will slowly start creeping out now that they've put their neck out there. Most of our commercial partners, you know, will be relaunching in some way or another within the next 2 to 3, 4 weeks.
So you guys are you guys where do you kind of fit in the BRRRR process? Are you guys more at the buy stage? Are you more focused on the refinance? Where would you provide the most value to your team to investors?
Sure. So my pipeline is honestly split pretty evenly between the purchase end and the refi end of a BRRRR. So we do offer like a hard money style purchase financing.
Yeah.
It varies state to state because we do broker for many different lenders. So the way we tailor your financing will vary a little bit depending on what market you're in.
Yeah.
But I can tell you that pre-COVID, we were doing a lot of 12-month interest-only notes with 90% of the purchase price funded plus up to 100% of your rehab budget.
Right.
And so these are great. You can use them either for flips because they have no prepayment penalty on them, or you could just refinance as soon as the property was stabilized. So that's what a lot of people did.
Yeah.
And on the refi end, the reason that so many people come to us for a BRRRR is one, they've already exhausted their conventional financing limits and we don't have any personal debt to income ratio requirements.
Right.
To back up a little bit, the whole idea of a commercial underwriting approach to 1 to 4 units is great, is because we're looking at it as if it was like a commercial building. We're judging it based on its ability to produce income.
Mm-hmm.
And so that was really the main qualifier for those loans was, does the net operating income cover the mortgage by enough to say, this looks like a good deal?
Right.
Yeah. And so the other reason that a lot of BRRRR investors would choose to work with us is that we allow for entity vesting. So a lot of BRRRR investors seek to vest title in a LLC or a S Corp, C Corp, LP.
Right.
If you've exhausted your Fannie Freddie limits, we have no limit on the number of finance properties you own. So naturally, that's the BRRRR strategy, right? You're trying to repeat. Eventually, you're going to hit your limit with Fannie Freddie. And it would become crucial. And then
so
lastly,
yep, go ahead.
Sorry. Lastly would be, and this is the big one, we were doing cash out refinances at 75% LTV as early as 90 days. So rather than a conventional loan that would require you to wait 6 months, and now it's looking probably more like 12, we were doing it at 90 days.
Yeah. So you guys are really a strong alternative finance option for people that, like you said, may not fit within the Fannie Freddie model because they've got too many loans. For example, of course, is the Fannie Freddie limit. They're only going to give you 10 loans on the properties that you can get before you run out of conventional financing options. And like you said, a bank is going to look at more of your income versus from a debt to income ratio and not factor in as strongly the rental income. I think a lot of banks will basically credit you like 75% of the rental income and then back out a piece for what the mortgage, et cetera, will be, and then add that to your income. So you might think, oh, I'm making $1,600 a month in rent, but really the bank's crediting you $67.
Exactly. And
not really getting.
Yeah. So a lot of investors who are actually very creditworthy,
right,
who are very good at bookkeeping, end up not being, eligible for conventional financing, which ends up, it's kind of silly. So we end up being an alternative and really ultimately a common sense approach, business purpose approach to lending.
Right. It's interesting. You can have somebody with a strong income. Somebody makes $100,000 a year and they have rental properties and they all cover the mortgage and they can't get any more financing. So
it is a little bit funny, right? You would think that they're the most creditworthy, but
right. How have things changed for you guys and in the market generally in terms of financing options and the kind of buyer profile that lenders are looking for now? We talked about, you guys are looking more on the worthiness of the asset and the cash flows, et cetera. It sounds like that may have changed a little bit. I know that the traditional financing options, banks have really tightened in terms of credit score requirements, et cetera. What are you seeing and what should people be thinking about so they're not caught off guard when they're going to look for financing?
Yeah, this is a big, tough question. I think the best way to look at this from a grand perspective is everybody needs to kind of go back to the basics. You need to be really concerned with reserves, FICO, and and how you look on paper. Ultimately, conventional financing should be what you're trying to get until it's not viable anymore. And
Right.
for that, I can supply that thing in California. Otherwise, you'll want to connect with a local mortgage broker. And in a lot of markets, I might have a recommendation. Feel free to ask later. But for those borrowers who qualify based on their W-2 income, financing is going to be exceptional right now. Purchase and rate and term rates are insanely low.
Mm-hmm.
One of the biggest wholesale mortgage lenders in the country yesterday rolled out a new Conquest program that's really trying to capture all of the best deals, right? The guys with 700 plus FICOs, great DTIs, and they're going to give them rates below 3%. So I mean, This is a phenomenal time. If you're looking, if anyone in this chat who owns their primary has a job and is paying more than 3.75% right now, needs to call a local mortgage broker and drop that rate, because in terms of, especially for primary residence loans. Sorry. So what should you be focused on? What is a hard money and commercial lender going to look for? Let's try to break it up a little bit.
Sure.
For hard money lending, it's been really, really, really easy to get for about 10 years. After the 2008 financial crisis, we saw, stuff like this was really hard to obtain for about 2 to 3 years. And then it opened up wildly again, and it's gone on a nice long run. A lot of first timers were able and willing to go get a loan for a very high leverage. But I think it's going to be very important to have experience in the mix coming up here. A lot of the lenders I'm talking to, some of them have remained open. Some of them are planning to relaunch. Almost all of them are saying, we're only going for top tier borrowers. You're going to have 3 deals in the last 3 years minimum. This doesn't mean you're out if you don't, right? There's always going to be smaller local hard money operations that are willing to cater to the first time investor. But more than ever, you're going to have to get on the horn. You're going to want to connect with a broker. A mortgage broker right now is as valuable as ever. And circling back to the idea of going back to the basics, so is a service like, BRRRRinvest.com, where it's really forcing you to cross your T's and dot your I's, because everything that was super easy and loosey-goosey, just a couple months ago is gone, right? So in terms of hard money lending, experience is important. If you don't have any, you may want to consider getting a partner that does. Showing the value that you provide, because it's just going to open more doors for you financing wise. I do expect leverage to be altered from hard money. You're going to find less people willing to lend at 90% of the purchase price. You're going to have to be prepared to come in a little bit more. Most hard money lenders, and I'm talking the biggest ones in the country, Lending Home, Civic, Lima One, Finance of America Commercial, all these big rehab lenders. Most of them are saying the same thing. They're probably not going to be willing to go past 70-75% of the purchase price for a while.
I wanted to ask you what you thought the numbers would look like in terms of down payment and what people should really be expecting. You think it's going to be? What do you think is going to happen on the refi side? You think it's going to be 75% of LTV, like people might be used to, or you think that's going to take a little dip also?
It's going to take a dip. I hate to say it, man, because as a guy who does BRRRRstrategyfunding.com and wants nothing more than to have smooth, clean, well-oiled BRRRRs flying through the pipeline, it's still going to be here. Look, these lenders are here to make money writing loans, and there's obviously an enormous appetite for these, right? But they're going to have to assess the risk. Right. And when they're writing loans based on rental income, and you see that on April 5th, only 67% of the country's renters had paid their rent for April. It's not good, and I don't actually know the exact total for May, but I imagine it's worse. So this is kind of opening up a little bit more of a can of worms, but I will say this. In terms of LTV on the exit strategy, it's very important to underwrite your deals to make sure they actually work at 65% cash out in the immediate future. I think that ultimately that lenders will open up a little bit, but if you want to be safe, your deals can't be completely contingent on a 75 or 80% cash out loan, because unless you qualify for, your agency debt still, you may be able to get that in certain circumstances, connect with as many lenders as you can. But if you don't qualify based on W-2 income and you do need an asset-based product like we and other commercial lenders do, unfortunately for a little while in the short term, you will need to be ready for lower LTV, especially for cash out.
Right.
And I'll tell you the reason why. Cash out, they just go by risk categories. Cash out refinance loans just have a much higher delinquency rate. So
what do you attribute that to?
What was that?
What do you attribute that to?
I don't exactly know. I don't know. I really don't know exactly why they'd be, because I guess I tend to feel like I'm dealing with pretty savvy investors who are conservative, and that loan is definitely no more risky than a rate and term refinance based on income, but the numbers tell otherwise. I think a lot of it has to do with the fact that people are pretty quick to dump the entire proceeds of a cash out refinance into the next deal.
Yeah.
And that brings up another point. And we're talking about how you got to get your numbers really, really dialed in the immediate future. I think this lending will come back, but ask any professional, no one can really tell you how long this tight period is going to be. Right. And 65% cash out seems optimistic from most of these people, but likely to be out there, right? Part of that is also going to be reserves. I still think lenders are going to allow cash out proceeds to meet reserve requirements, but they're probably not going to have 6 months reserve requirements like they did before. I think investors should be prepared for an underwriting guideline that says you have to have 12 to 18 months in reserves to qualify for this cash out refinance. Well, luckily, on most good BRRRRs, the cash out should cover that. Right. And I really hate to sound like doom and gloom on this webinar, right? Because things could end up better. I am trying to be a little conservative right now and not overpromise anything to anybody. I'd much rather see people batten down the hatches and make really conservative decisions here. But one thing I have heard a couple of commercial lenders tell me is that in their meetings, they're talking about maybe even requiring a certain amount of prepaid. So they may ask you, some commercial lenders may require that 6 or 12 months of at least interest, possibly even principal and interest, be paid at closing. That's how risky these loans are right now, with half the country out of work or more. Right. So I think it's miraculous that we're even seeing this coming back in the summer, in the shape that the economy's in. Yeah. So in the immediate future, I guess at a basic sense, things will be available, but much, much more conservative. Yeah. So there's with all kind of negatives, there's also a chance for opportunity, right? Where should people be jumping in right now and saying, okay, now is actually the right time to make an investment? Maybe you think maybe it's not, but what are your thoughts around that, and where people can get some leverage? Here's the thing. And this is always true. When lending is super tight, the deals are everywhere, right? So part of this lending being so tough is because loans are going into default, right? So lenders are tightening up. This forbearance Band-Aid will not last forever, and there will be a tsunami of foreclosures. So the best thing an investor can do right now is strap it down, have good reserves, have cash on hand. If you have a way to cash out one of your properties with a conventional loan right now, I would recommend doing it. There's probably never going to be another good time to have cash on hand to buy properties. Right. Here's the other thing. Sense. Yeah, go ahead. With conventional financing getting so tight, with FHA getting so tight, with Chase Bank saying you cannot get a loan without a 700 FICO. Right. These are huge moves. You got to remember, millions of home buyers buy homes with 620 FICOs. If they can't, that's that many less buyers. And you're just going to see houses pile up on the market and prices drop. Right. Do you expect to see more of a rework situation between lenders and borrowers than we saw 10 years ago, and lenders not bringing as many assets on their books and trying to keep people in their properties? And what do you think lenders are likely to do this go around versus the 2008, 2009 time period? Well, it's tough to completely differentiate the two periods. I think that there will be enormous efforts from the federal government to limit the pain, right?
Yeah.
But ultimately, let's just forget your typical homeowner for a second. Like I said, lending has been very easy to get for 10 years. That means there
Hmm.
is thousands and tens of thousands of investors out there that are kind of flying by the seat of their pants.
Right.
They're super leveraged up. They have very minimal reserves. They have many properties, and they cannot afford many months of rent not being paid.
Right.
And I hear a lot of good things. I hear a lot of investors telling me that, hey, I have all 18 of my tenants paid on time. One guy asked for a 3-day extension. I'm like, wow, that's awesome. You hear
Yeah.
that, but at a nationwide level, the numbers, say otherwise. There's a lot of people not paying rent.
Right. Yeah. So the reason we connected and what I wanted to help people with tonight too is differentiating between, you touched on this a little bit before, but people know, lenders know that people need money right now, and there's a lot of what seems to be bad information going around about and over promises in terms of LTVs and credit score needs, etc. What are some things that people who are looking for financing should be looking out for so they're not getting potentially taken advantage of by somebody who thinks this is the right time to take advantage of folks?
Yeah, as much as this is as much as real estate is a numbers game, it is inevitably a people's game. even
Yeah.
in this era of many interactions in the future to take place via Zoom, you're gonna want to surround yourself with people you trust. I can say this for sure that a lot of people in my industry, loan officers in general, do blow smoke. They are more or less trained to get as many leads as they possibly can, throw that mud on the wall and see what sticks. Me personally, I've been doing it long enough to not have the stomach for all those canceled files and everything like that. So I try to kill the deal up front. You're honestly going to want a loan officer that doesn't promise the world right now and takes
Right.
and uses pretty good scrutiny against your scenario, because that's ultimately going to get your deal funded.
Right.
As far as what to look out for, I wouldn't follow the mainstream media too much in terms of mortgage stuff, because they tend to be sensationalist and leave out really important details.
Yeah.
Just an example is that, you'll see CNN blast out a rate, and that's for like a very specific mortgage, like a 15-year fixed note, right? And everyone thinks they can do their 30-year fixed at that rate. In general, commercial lenders right now are hungry. No one's been getting paid in 2 months. You can imagine that LOs are going to be doing anything they can to get you in the door.
Right.
I guess I would say that now more than ever, whether it's me or somebody local to you or somebody you already work with, a mortgage broker is more valuable now than ever, because they only get paid when the deal funds. Their job is sifting through all the other account executives' BS, right?
Mm-hmm.
So I get inundated with newsletters every day from every bank in the world telling me what they have, and I can kind of translate it in my own head. But you get on the phone with them and you can kind of understand who's overpromising once you have the context of what the lending landscape is based on this conversation here.
Right. Have you seen lenders, traditional lenders, commercial lenders, et cetera, hard money lenders adjusting fees to make up for the decrease in rates, or pricing themselves out of the market at all? What are you seeing on that front?
Yeah, so we're talking about risk, right? You have to remember that from the lender's standpoint, these are going to be considered riskier loans now, just based on basic economic numbers like unemployment.
Yeah.
That being said, they're going to want a higher return for their risk. So while conventional rates are going to continue to be amazing, cash out is still going to be more difficult to get in a conventional world. Don't want to dive too far into that right now.
Yeah.
But yeah, rates, we were at a beautiful time. Like I said, lending money had almost never been as easy to get.
Mm-hmm.
I'll give you an idea. In March, we were doing the average BRRRR deal we were doing with no income verification of any kind. I didn't see your tax returns, your W-2s, or anything. No limit on the number of finance properties, all your property had to do was debt cover. You know, we were mainly writing loans at 75% LTV, 90 days cash out, 30-year fixed in the low fives at par, and they could have been bought down into the fours. That's with no income verification, right? This has literally never been better. Okay, so they're not going to go right back to that. Angel Oak, we brought Angel Oak up earlier in the conversation. They just put out their first, this is the first DSCR program back on the market. There's no cash out allowed. It's only purchase and rate and term, but it is based on a DSCR. So it's a great sign. Rates were not good. The max LTV on their program was 60, and the rates were in the high sixes. Mm-hmm. I do expect, at least in the short term, and this is why Adam and I talked about we may need to redo this meeting in a month because so much is going to happen in June. Like
it's true. We'll see you guys in a month.
Yeah, definitely going to need an addendum here. I do expect, honestly, even the best commercial lenders for their max cash out on a 30-year fixed, conservatively, I think rates are going to be in the high sixes, 7 to 8% range. Yeah. Kind of where they were a few years ago, honestly. Mm-hmm. But to be honest, don't take this as doom and gloom. You just got to work it into your numbers.
Right.
If you're going to be utilizing commercial financing.
Right. Have you one part of the equation when we're looking at BRRRR and a refinance, 65% LTV, 70% LTV, is obviously figuring out what that ARV is going to look like. Are you starting to see it all? And I know it's going to vary kind of market by market, but on a more general landscape, are you seeing prices of homes start to decrease some? Are you starting to see it all appraisers building in any kind of discount for what's to come? Anything that would kind of disrupt somebody's ability to accurately evaluate what an ARV might look like on a comp that they're using to do their own calculations for their next project?
Yeah, so I mean, there's no doubt that sales volume is down quite a bit, right? Just for the simple fact that yes, you can do Zoom home viewings, but people are less likely to buy their home without the chance to walk through it. And like you said, it's very market to market. Yeah. So I've heard some very weird examples where volume is like really good in a town like Charleston. Yeah. Apparently it's extremely competitive and people are paying over asking still, and it's like a bloodthirsty battle. But you need to be concerned with comps, right? So I think it's going to be more of an issue in more rural areas, areas closer to major metros that are still going to have quite a few comps in the immediate area are going to be more reliable. Right. But like I said, back to the basics. With everything, be conservative. Whatever you think the ARV is, shave some off of it. Yeah. Because your appraiser is going to likely try to use the nearest comps within the last 3 months if you can. Yeah. Don't stretch your BRRRR deals out because you think you found a great comp. Scrutinize that comp. Think of all the reasons that's a bad comp, right? Right. Because I have seen that mistake made many times. Yeah, even prior to this, I think that too many investors will find the best comp in an area that's 2 miles away. Stick within a mile if you can, and shave a little fat off of everything. Right. Right. Yeah, it's important to look at those trends, and obviously it's knowing your market, especially I'm originally from Buffalo, New York, and I invest there, and actually the prices are going up some because the inventory is so low, and there's still people that are moving around. So it's actually, everyone wants to get out of the city. Yeah, everybody wants to get out of the city and get some more space and country life. So it's an interesting time. And I think that's a trend you will see. I think a lot of people who can afford it will kind of try to spread out a little bit after something like this. Yeah, absolutely. Absolutely. I want to jump into I think we have a couple of questions here. If you guys have questions, please just type them in, leave them in the box here. We've been going for 40 minutes, so I want to make sure everybody gets a chance. I'll just read the questions for you, Alex, and sure. I'm in as well. Question from Mark Lewis: is doing a cash out refinance that much different than taking out a line of credit on a BRRRR project? Does either have more or less benefits than the other? Well, I think you touch on an important point. You know, in the 2008, after 2008, a lot of people's HELOCs were just closed. The lenders just closed them off. I think that you're going to find it harder and harder to get a line of credit on an investment property.
Yeah.
Is it much different? They're very similar in some ways, and different in others. In a cash out refinance, you're paying off the whatever existing lien is there and taking the difference between that and the loan amount. But to answer your question, I don't think BRRRR investors should consider relying on taking out lines of credit on investment properties. It's simply not going to be there for a while. If you have one on your primary, great. I would liquidate it and buy some real estate.
Yeah. Have you seen any dips in HELOC rates going out on properties?
So personally, as a mortgage broker, we really don't do a lot of I don't personally do any HELOC business. It's really the job of big banks like Bank of America, Chase, and Wells Fargo.
Yeah. Okay.
Wholesale lenders just simply don't offer as good a pricing. So I don't originate HELOCs. So
right. And there is a limited number of folks in my experience that are doing it on investment properties, unfortunately. So it does.
Yeah. So,
but hopefully that cash out refi is a good option.
The one thing I didn't touch on.
Yep.
Sorry, real quick, and it's just made me think of it from his question. As all these things are going on, I think that as much as this is a great time to shop, no matter what you're doing, talk to as many lenders as possible, right? But the one source of funding right now that has been more consistent than anything is small local depository institutions.
Yeah.
So, I can't possibly know what every single one of them is doing, but I would definitely speak to local credit unions, ask to speak to a loan officer or specifically a commercial loan officer. And I know that I'm seeing at least on Bigger Pockets, some people are able to secure high LTV cash out refis on investment properties still.
Right. What would you say to somebody now who's thinking, I have a property I could refi. I'm not sure if I should do it now because I don't know if I'm going to buy anything in the immediate term. I want to see what prices are going to do, or I'm just not sure. Is now the right time to think about a refi, or would you potentially wait and say, I might as well, if I'm not going to reinvest, I might as well keep my cash flow higher than it would be with a mortgage on the property. What should I be looking at?
Well, I think if it's an investment property and you don't qualify for a paper conventional, you may have missed the boat on that decision, just because simply tied up right now. If it's your primary and you have that opportunity to do it at these rates, you got to do it. This is you'll never find cheaper money to borrow from your own house. I mean, I'm doing a cash out refinance right now. It's a little bit of a low LTV deal, like 60% LTV. Cash out refi, 30-year fixed. This is a paper conventional in California, the only place that I can do that. At 3.365, and they didn't buy it down at all. That's like at no cost. So, if you have the opportunity to take some cash out now at a rate like that in the low to mid threes or even lower in some cases, talk to your local mortgage broker and do it. Because if you're serious about investing, you're going to have cash on hand because, like I said, lenders are going to dial back their leverage.
My only caveat on that would be to make sure to look out at the fees also. You don't want to jump from a 3.5% mortgage to a 3% and get killed on fees.
Yeah. In a lot of cases, I'll just because I don't, my conventional lending isn't my thing, right? So just completely transparent here, like Quicken Loans, United Wholesale Mortgage, still offering cash out refinances at great rates. And honestly, because they're kind of like the last giant still standing in that market, there's a lot of great lender credit opportunities, right? So this cash out refinance that I'm doing right now is literally at no cost to the borrower. The lender credits pay for all of the closing costs. So talk to your mortgage broker. Cool.
Troy had a question here about a mortgage broker in Birmingham. I guess, I'll share, of course, we'll share Alex's contact information when we wrap up here, but Alex, maybe you want to talk, and it's probably a better question of where you're not doing business, but give people a sense of where you could help them out, what markets.
Yeah, so it varies a little bit on the type of loan, whether it's hard money purchase or a cash out refi, or like we said, a commercial apartment style thing. But generally speaking, I can do the vast majority of states, with the exception of a few that require that the broker be licensed and present in the state. And those include Nevada, Utah, Idaho, North and South Dakota, and Vermont. And Oregon, sorry. So pretty much everything else, right? All the major Midwestern BRRRR markets and Southern BRRRR markets are on the table. I'm a licensed in California, so a lot of brokers who do what I do outside of California can't do inside of California because California is one of those states. So yeah.
A lot of options.
Alabama's great.
Unless you heard your state mentioned, now's a good time to talk to Alex and get that relationship going, etc. So, Angel, Hartfield question: if I have no current income but I have savings, would I need to wait to start investing? I guess that can kind of be divided between what does a lender have to say about that versus what can I do on my own without a lender, right? So there's always options. I guess I'll take this to start, and then of course, Alex, whatever your thoughts are. But if you have enough savings to get started, and you're not relying on a financing source, or if you have savings that you could potentially bring in a partner, some other means, not having an income is going to hurt you with lenders, but that doesn't mean it needs to hold you back, nor does it mean that if your circumstances change in the future that you can't fit within that cleaner box to refi out of a project. Like Alex mentioned earlier, work with somebody who does qualify so that they can participate, see how you can make it work. But it's all just, I think it's really just being creative, especially if you fit kind of outside that normal square of what lenders would look for.
Yeah, you're going to have to be creative. That's great. It depends on what savings means, right? If you can get into an all cash situation right now and do it, great. There will be some sort of asset-based exit strategy in one way or another a few months down the road from now, short of some huge second wave of coronavirus. But yeah, if you want to get conventional financing, income is going to be an absolute requirement. And even if you have income, it's going to be scrutinized. One of the cash out refis I'm doing right now, conventional one here in California, I have 2 employed borrowers that have been with the same job for a decade. One of them is in aerospace. The other one is a court reporter. Mm-hmm. Los Angeles County has no regular court proceedings right now. So her income is severely impacted, but it's all pent up volume. And the moment that courts resume, she's going to obviously be slammed. Lender doesn't care. Right. They're going off of past 30 days for self-employed borrowers. Self-employed borrowers have heavier reserve minimums, and they have to now have, in most cases, a CPA audited profit and loss report. I mean, I'm a self-employed borrower. I don't have a CPA audited P&L. Most people don't. So batten down the hatches if you're self-employed. Really, you're going to have to build your case in a lot of these scenarios. Yeah. Income is important, but if you don't have it, like I said, purchase terms on these commercial loans are still going to be available. They may be strict on certain things. Like if it's your first investment and you're looking for a commercial loan, you can almost guarantee they're going to want to confirm you own your primary residence, or someone on title does, right? A partner. Because one thing about this style of lending too, to back up a second, is that the reason it can even really be done in this way is because it's not subject to Dodd-Frank. And they will not lend on owner-occupied properties. That being said, they really want to rule out that you're not going to live there.
Right. There's a lot of people that have had dips in income or been furloughed or any kind of these things that we're hearing about that are affecting people's overall income. Are you seeing lenders require kind of a catch-up period where you have to basically show that you're getting yourself back in a position, maybe the pay cut that you had is going to stabilize? Are they making you wait, say 3-6 months so they can look back and say, okay, things have stabilized for you? Or is it a tighter look back period that lenders are focused on?
Well, I'm not sure how to answer it in terms of like a look back period, but more what I can say is that they are verifying your conventional loans that require income, unlike what I mainly do, are verifying your income multiple times throughout the process, including a mandatory like verbal VOE. Like they're going to call your employer.
Wow.
And they're not only going to verify you have a job, they're going to ask them, has their hours been affected? What is their exact pay rate currently?
Right.
Like in the case of my aerospace client, they did some sort of furlough style program where they have each employee taking 1 week off a month, otherwise working full time. But they did take that into consideration. Luckily, he had great income, well over 100 grand, and even taking the big haircut, it didn't matter. But it's something to be concerned with if you're on the cusp.
Yeah, the diligence is more challenging. So,
and I honestly, that being said, for anyone who doesn't have that straightforward W-2 income or for anyone that has been impacted by COVID, a lot more people are going to have to rely on commercial and non-QM financing that is asset-based. And those folks who don't have those perfect W-2 incomes are going to be more reliant on cash on hand, bigger down payment.
Right. That's why we're talking. We started talking because I'm living overseas in Colombia, don't have W-2 income, and everybody says, what are you doing living in Colombia for? What's going on here? So, but there's ways for people to work it out. Let's run through the questions because we got like 10 minutes. I don't want to take up too much of people's evening, but want to make sure we get to all the questions. So first one, you mentioned personal conventional refinance could be low threes or high twos. What about non-owner occupied?
Like I said, a lot of lenders have either suspended it depends on if you're talking about rate and term refinance or cash out. Rate and term, still phenomenal on investment properties. Go talk to your broker and make sure you're getting a good shake. Cash out becomes a little bit tougher to find. Like I said, a few big lenders are still doing it. Quicken Loans, talk to a broker about United Wholesale Mortgage. Odds are that they're a mortgage broker, they use United Wholesale Mortgage. Still doing cash out in investment properties, just with a lot of overlays, meaning they're taking big haircuts off the rental income, high FICO requirements, things of that nature.
Right.
But still out there. So what are the rates? You can still find stuff sub 4 for conventional.
Mm-hmm. Even on investment property. So that's going to still be attractive to people. The question, I got a 650 credit score. Can I add my wife who has 800 W-2, possibly make it easier to get a refi? So can you combine your scores with your spouse to help you along the way?
Really, really good question. So a lot of commercial lenders up until this point, I'll answer every question like that. Up until this point, have actually tended to use the higher of the two mid scores on a loan like that.
Yeah.
So in that case, you'll actually get 800 credit score pricing tier. But the caveat is anyone on the loan may have to meet a minimum. So for example, like one of the biggest commercial providers we use had a 620 minimum, meaning everyone on the loan had to have a minimum 620, but we would use the highest of everyone's mid scores as the qualifying FICO. So yeah, great idea. Partner with your spouse if you can, if they have a higher FICO.
Great. Question from Mike. I have a single family home finished this week. Everything brand new, better to refi with or without a tenant. This probably goes back to your point about seasoning periods and how, it was for you guys 3 months, conventional 6 months. Now it's looking like maybe 12 to 18. So that's obviously something to keep in mind, and you're most likely to have a tenant at that point. I haven't seen any kind of penalty for on a refi, because it's occupied. I think that would be more attractive to a lender.
Yeah, and if you're talking about a non-conventional loan like I would do, it's going to be an absolute requirement for long-term financing. If you desperately need cash out or need to pay off the private note or whatever, you can get some sort of like 12-month note if you don't have it, if it's vacant. But if you want long-term financing on an investment property, not based on your DTI, you're going to need a tenant in there. And I'm really glad you asked that, because in the wake of unemployment being as crazy as it is, lenders like the ones I work with are going to be probably diving deeper to verify that rent. One thing I would strongly discourage right now is doing things like accepting rent in cash, or accepting rent in ways that are a little harder to prove, like Venmo and PayPal. I would strongly suggest being able to produce canceled checks,
Yeah.
and things like that, because they're going to be diving in deeper.
Right. The one thing I would recommend for people who are signing lease agreements is to make sure that you're specifying the forms of payment that you'll accept. You know, to Alex's point, you don't want to have somebody give you cash and you tell them, I don't accept cash, and then you're arguing about whether they paid you rent that month or not. So make it very clear from the outset that you guys know what the expectations are, and you really don't. We all want to do this to make it kind of a passive thing. You don't want to be having to meet with tenants every month to get envelopes of cash, et cetera. So make it easy on yourself and just specify it up front, and you'll be good on the lending side as well.
Yeah. Lending's not the only reason you shouldn't just take rent in cash.
Of course.
Yeah.
Cool. We really have like some great questions. So if you guys want to stick around like an extra 5 minutes, that would be good. We'll fly through them. Besides hard money loans, or any way to get in less than 20% down right now?
Ooh, less than 20% down on investment properties, gonna be tough.
Yeah.
With the exception of private lenders. And you know what? One thing I think we're gonna see in the wake of all of this is a lot of people with a lot of cash on them becoming interested in becoming private lenders. It's a great way to invest in real estate, high returns, and highly motivated people to pay those things back in a short time frame. So, you're gonna if you're gonna be relying on heavy leverage like that, it's gonna be more important than ever to connect with some people who have cash that could possibly finance your projects, and show your value, show your ability to break down a deal like Adam does and provides the tools to do. That way you can present it very clearly to potential financiers privately.
Excellent. I invest in Midwest market, low RVs. I think this is a great question, because a lot of people, like we had, the question just a few minutes ago, well, I've got some savings, I'd like to invest, but, I want to start out and I need to look at properties that have potentially lower ARVs, or that I can get in at a lower price point, but I'm scared about the refi aspect. Are you seeing, Alex, folks be able to refi on properties that don't cross, the 100,000 threshold, or they're at a lower price point?
The answer, I'm not seeing it. I think that the vast majority of lenders I work with, even huge nationwide non-government backed lenders, had already had kind of a $100,000 loan minimum. One of my favorite programs had a $75,000 minimum, and I loved it because these loans you guys are talking about, these are great deals. They cash a lot of these properties that are worth $100,000 are actually cash cows. They're amazing, but they're really hard to finance, and that's because these lenders have to make yields, right? And it takes a lot of resources to write a loan, between all the staff involved, between processors, underwriters, closers, the originators, everything involved, that it makes it hard to justify writing those small loans. Now, there's some caveats to that. One, like I said a little earlier, way ahead of schedule, go talk to a local depository institution like a credit union that has other streams of revenue besides writing loans, that has a little bit more flexibility. They are much more likely to offer a loan less than $100,000. I keep bringing up Angel Oak, and I hate to kind of bash them, but I'm using it as a case example kind of. I saw on their DSCR program, they actually raised their minimum to 125, which that kills a lot of BRRRR deals. I'd say a huge amount of the BRRRR deals I was doing had ARVs around between 100 and mainly maybe closer to 150, and they were just above those minimums, and those actually made for great deals where you were very likely to get all of your initial capital back out.
Right.
So loan minimums are going to be important. One more caveat to that, sorry.
Sure.
I saw somewhere in there about portfolio loans. there's a couple of different connotations with that. One, sometimes when people say that, they think of blanket loans, so loans that encompass multiple properties. I don't think we'll see a lot of those come back as quickly in June, maybe in July, we'll see. But some of those programs would cash out at similar LTVs, 75 pre-COVID, probably like 60, 65 now. But what they would do is allow you to blanket multiple properties together. Usually they'll still have a per property minimum, like $40,000 or $50,000, but and they'll also have a loan minimum. Typically it's like $250,000 or $500,000. But if you're doing many, many BRRRR deals, it can make a lot of sense for you.
Alex, this is great. We got a lot of kind of personal situation questions. I want to share your website, email, etc., so that people who have fact patterns specific to them can find you and work through things on an individual basis, if that works for you. So, you guys can find Alex at investorpropertyloan.com. I'm going to send another email after we're done tonight and make sure you guys have everybody's info, and Alex's number is on the website, and feel free to give folks your best email and where people can find you, Alex.
Yeah, a couple places you can find me. I'm super active on BiggerPockets. My website is BRRRRstrategyfunding.com. My email is super easy. It's alex@investorpropertyloan.com. And I think we have all this stuff in the notes. If not, we can add it to the list.
Yeah.
But yeah, I'm happy to give recommendations, point everyone in the right direction that was awesome enough to join us tonight. I'll be quick to let you know if my expertise is valid in your situation or not, but nevertheless point you in the right direction.
Yeah. Cool. And for you guys, Alex has been kind of generous enough for those of you who are with us or soon will be with us, if you join us at BRRRRinvest.com, reminder, we have there kind of the full deal analysis, legal solution that I've used for the last 10 years to do all of my properties, and really contains all the things you read about in all the books, BiggerPockets, etc., of the terms, etc., that you need to be including in your contracts with your contractors, property managers, tenants, etc., so that you're really protecting yourself and saving yourself a lot of hassle. I've got it all there based on my legal experience. We've done the calc, and it looks like about $675 save per deal that people do. So the cost you're saving in terms of time, hiring lawyers, etc., really makes it a value add. So in the email I send around, I'll share a link there for you. But Alex has been generous enough to give anybody who's a member with us $100 off of any loan product that you work on with him for the first deal you guys do together. And what I want to do is kind of sweeten it a little bit. And for anybody that signs up in the next 48 hours, I'm going to give an extra $25 to use for any of our products. We have BRRRR deal checklists. We got interview tools that you can use that are going to help you a lot with these questions that you want to ask to lenders. A lot of the questions that you heard tonight are included there. You can type in your answers, compare them side by side. Tons of tools there. I'm going to throw that in as a bonus gift to you guys, because we appreciate you being here with us. Make sure you send me or Alex any of your questions, and really grateful for Alex, you joining us, and the time that people shared with us. So it's good. We'll probably see each other in another month with another round of fresh answers and
more good news, probably.
More good news, and ready to do some more projects and get some more properties in our portfolio. So thanks to everybody. Thanks, Alex, and we'll see you soon.
All right. Thank you, everybody.
Thank you.